So we have seen strength in markets this week after a sell-off last week. Our guest argues that quality-focused value investing has been out of favor in recent months, but he argues that patient investors will ultimately prevail. We're joined by Jason Del Vicario, portfolio manager at Hillside Wealth Management at IA Private Wealth. Jason, great to see you. That's your case then. You think value investing has just been out of fashion, investing in stable, high-quality companies?
Yeah, I mean, there's been a bit of a bifurcation that we've noticed in the markets that really started around sort of July, late summer, where the types of predictable, sustainable, quality, sustainable return on equity, founder-run, founder-owned, the types of businesses that we favor at Hillside to own for our clients for the long term, were really kind of taken out back as investors clambered over themselves to buy the likes of NVIDIA and the AI and Bitcoin and gold and so on and so forth. But at the end of the day, cash is king, cash flow matters, and we think that ultimately that patient investors, as you noted in your introduction, will be well rewarded over the long term.
You like to avoid companies that avoid competition, I guess, particularly on price. Yes. How would the AI companies fit into that thesis?
Quite frankly, I'm not that familiar with the AI companies. I mean, I think when you have a boom like this, you probably do want to invest in the pick and shovel, so to speak. So I think NVIDIA certainly is a leader. I believe they have something like 90% market share. So that would fit within the context of avoiding competition. The concentration of their revenue, I think, could be a concern. I've read reports that upwards of 60% of the revenues come from just 4 customers. And of course, the repeatability or the recurring revenue nature of their products and not really much service revenue would also give us pause. We like to own companies where there's frequency of purchases or frequency of activity. And for us, we like to bet on the winners once the race has started. To us, it's not really clear yet who the winners will be in this AI trade, so to speak.
Are we in an era of speculation and hype aimed at investors?
It feels that way. Again, I mean, when you see a lot of money going towards companies that either have no profits or trading at 50 to 100 times earnings, I don't see how you could conclude otherwise. But I will say that when we think about bubbles, when everybody is talking about there being a bubble, that's usually a situation where there isn't a bubble. So the fact that many people are talking about an AI bubble or a tech bubble today, my contrarian sort of radar antennas get triggered, and just from that perspective, I would suspect that we're probably not in a bubble yet. It's when everybody just assumes that things will only go higher, that whether it's AI or tech is really the only way forward, and these are only the types of investments to hold, and complacency sort of rears its head. That's probably when we will be at sort of peak speculation. So just from that little tidbit, I'm not convinced or prepared to say that we are or aren't in a bubble at this time.
On the theme of being a contrarian, Constellation Software, you think investors have been too hard on this stock?
I wouldn't necessarily say that investors have been too hard. I mean, this is an example of a company that was very richly valued, trading at over, say, 50 times earnings, and has now come back down to around 30 times. You might not see that when you pull up a Yahoo Finance or a Google Finance. You do need to make some adjustments to their earnings to look at what their actual cash earnings are. But this is the first time in 10 years. I mean, it was 2014 when I first featured Constellation Software as a top pick at around $250. And I haven't since then, not because we don't own it, not because it's a large position for us. It's just that between now and then, it has been relatively expensive. And it has since now come down to a level where, especially if you don't own shares, if you've been watching Constellation for a number of years and always thought it was a bit expensive, I do think that current levels offer reasonable value, not exceptional value, but reasonable value for those who don't own it or perhaps would like to add to their positions. And I would also throw in Topicus and Lumine, which were their two spin-offs. They have been sold off quite a bit as well. I mean, I could go over why they've been sold off. Obviously, Mark Leonard has stepped away due to health reasons. People are concerned that everybody's now going to be able to develop software on their own using, large language models. We think that is certainly overdone. And as you noted, I think that the shares have sold off more than certainly is warranted, given the business fundamentals and the unit economics of this business, which again is exceptionally well run.
A stock that has suffered lately, Novo Nordisk, the Danish weight loss drug giant. Investors seem to think Lilly has won this race for now.
Yes, in the short term, Eli Lilly has certainly been eating their lunch, at least in the U.S. market. If we look outside of the U.S., Novo Nordisk is still clearly the market leader, both in terms of diabetes, insulin care, as well as obesity care. The stock is down, I think, something like almost 70% from its all-time highs, trading in the low teens with a reasonable dividend yield. Let's still not forget that this is a duopoly. So Novo Nordisk is not going away. They're a 120-year-old company. And we think that shares at current levels represent tremendous value. But obviously, there's going to be some volatility in the near term. And we've been accumulating shares over the last few months here and feel comfortable with the position that we have.
Jason, thank you very much indeed for giving us your thesis there. Jason Del Vicario, Portfolio Manager at Hillside Wealth Management at IA Private Wealth.